Please come to next paragraph 11, determining the acquisition date. How many steps are involved in this combination accounting? 6 steps. So in the first lecture we have discussed identifying the acquirer, that is the one who acquires the control. Second step is to determine the acquisition date. The significance of acquisition date is this is the date from which the acquisition accounting begins. This is the date when goodwill is calculated. This is the date when fair values are calculated. So therefore one has to calculate the acquisition date carefully. Now the question is, what is acquisition date? Acquisition date is the date on which the acquirer obtains control of the acquiry. The acquirer obtains control of the acquiry. That is when they get the power to direct the relevant activities. Is called the acquisition date. There is also called closing date. But closing date is not always equal to acquisition date. Closing date is the date on which the acquirer legally transfers the consideration, acquires the asset, and assumes the liability of the acquiree. This date is referred to as closing date. The date when consideration is paid, assets and liabilities are acquired. Sometimes they may be same, sometimes they may not be the same. So acquisition date need not be the closing date. You may acquire control first, pay the consideration later. Vice versa. You may pay the consideration, but you may obtain the control at a later date. So we have to look at which date? Acquisition date. We don't have to look at closing date. For the purpose of further accounting, acquisition date is relevant. It is possible that the acquirer might obtain control on a date that is either earlier or later than the closing date. Next point is the acquisition date needs to be determined correctly. What is the relevance of the acquisition date? The significance is that the recognition and measurement of assets and liabilities revolve around the acquisition date. Right? Recognition, measurement of asset, liabilities, goodwill, gain on bargain purchase will start from acquisition date. So therefore we need to find out the acquisition date correctly. So dear students, solve this next wonderful question. Company A acquired 80% of the equity interest in Company B for cash consideration. Relevant dates are date of shareholder agreement 1st June, appointed date as per shareholder agreement 1st April, but the date of obtaining control over the board representation, is 1st July. Date of payment of consideration 15 July. Date of transfer of shares to Company A is 1st August. Now the question is, what is the acquisition date? 1st June, 1st April, 1st July, 15 July. When did you acquire control? Is the date of shareholder agreement the date when you acquire the control? No. Is the date appointed date as per shareholder agreement? No. What is important is the date when you acquire the control over the relevant activities, and that happens when you get the representation on the board. So therefore your answer would be the date of obtaining control over the board representation. So write down in this case, as the control over financial and operating policies are acquired through obtaining board representation on 1st July 20x1. It is this date that is considered as the acquisition date. It is this date that is considered as the acquisition date. You have to see when did you acquire control. Other dates given are formalities. This is the date which gives you the power to direct relevant activities. It may be noted that, write fast, question number 14. It may be noted that appointed date as per the agreement is not considered as the acquisition date, as the company A did not have control over company B as at that date. Is it right? Company A did not have control over company B as at that date. Try one more question. Can an acquiring entity account for a business combination based on a signed non-binding letter of interest, where the exchange of consideration and other conditions are expected to be completed within 2 months? Say, what is your answer? Can an entity account for business combination based on a signed non-binding letter of intent? Non-binding letter of intent means this will not give you control. Okay, it is only a letter of intent. Letter of intent means we want to do this activity, where the exchange of consideration and other conditions are expected to be completed within 2 months. What is your view? Can this company account business combination by signing a non-binding letter of intent? The answer is no. 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 Full stop. As per the requirement of the standard, as per the requirement of the standard, a non-binding letter of intent does not effectively transfer control. Right? Does not effectively transfer the control. This cannot be considered as the basis for determining the acquisition date. This cannot be considered as the basis for determining the acquisition date. This cannot be considered as the basis for determining the acquisition date. Now, dear student, come to one more question below that. On 1st April, Company X agrees to acquire the share of Company B in an all equity deal. X acquired B, and how did they acquire? All equity deal. Equity share will be acquired. Equity share will be issued. As per the binding agreement, Company X will get the effective control on 1st April. However, the consideration will be paid only when the shareholders' approval is received. Underline. Consideration will be paid only when the shareholders' approval is received. The shareholders' meeting is scheduled to happen on 30th April. If the shareholders' approval is not received for the issue of new share, then the consideration will be settled in cash. What is the acquisition date? 1st April only, not 30th April. Why? Control is transferred. It's only a matter of deciding how the consideration will be paid. Even if it is paid in share, control is transferred. Even if it is paid in cash, control is transferred. So the mode of payment will not affect my date of acquisition. If it was subject to approval of shareholder, that is, business combination will take place subject to approval of the shareholders, then in that case you will have to wait for the shareholders' approval. But if the shareholders' approval is only to be taken to decide the mode of payment, then we can take 1st April as the date of acquisition. This is the date when control is obtained. So write down 2 lines. The acquisition date is 1st April. Write fast. The acquisition date is 1st April. In the above scenario, even if the shareholders don't approve, the share consideration, consideration can be settled through payment of cash. Even if the shareholders don't approve the shares, the consideration can be settled through the payment of cash. Control is transferred. It's only a decision about how it should be now settled. But it will be settled, that is sure. Cash or share. Okay, now one more question. A enters into an agreement with the shareholders of B on 1st April 2011 to acquire a controlling interest in B. The agreement provides that effective date of transfer is 1st April 2011 and is subject to approval by the shareholder of A at a meeting scheduled for 1st July 2011. What is the acquisition date? When the shareholders approve. Okay, it seems that your answer is right. Because in this example, the decision for the acquisition itself depends on the approval of the shareholder. Previous example, acquisition is certain. Mode of payment is only to be decided. So in this case, your answer would be 1st of July. Because if shareholders don't approve, then this combination will not take place. This agreement will not move further because the agreement is subject to approval by the shareholders. So your answer is wait till 1st July, let the shareholders approve, and if they approve, then 1st July. the voting rights are not transferred and the board of directors remain unchanged. The voting rights are not transferred and the board of directors remain unchanged until the approval of its shareholders. That is on 1st July 2011. Is it done? Good. Now come to one more point with respect to date of acquisition, and that is called step acquisition. What is step acquisition? First you acquired 20% share on 1st July 2019. Then you acquired 50% share on 1st July 2020. Now your total share is 70%. Now in this example, what is the date of acquisition? Is it 1st July or is it 1st July 2020? 19 or 20? 2020. Why? Because this is the date when control is obtained. This is the date when control is obtained. Is it right? So that is called step acquisition. So in case of multiple acquisitions, the date which gives you the control is the date of acquisition. Now in this paragraph, they have also discussed some accounting, which actually we will discuss afterwards also. So this paragraph might be repeated in some other paragraph also. Right now the topic was only the date of acquisition. So in case of step acquisition or multiple acquisitions, that date which gives the control is the date of acquisition. So in case entity acquires another entity, step by step, through a series of purchase, acquisition date is the date when the entity acquires the control, and till the time you acquire the control, you will apply other standards. For example, IFRS 9. For example, if the investment is an associate or a joint venture, you will apply IS 28. Example of step acquisition. On 31st December 20x1, entity A holds 35% interest. Then on that day, entity A purchased additional 40% interest in B. Now you have total 75% share. Identify the date of acquisition. So the date of acquisition is when this additional 40% shares were acquired, which is 31st December. This transaction is referred to as step acquisition. Now in business combination achieved in stages, it has two names: step acquisition, short name, and the main name is business combination achieved in stages. What you will do, that is the acquirer will remeasure its previously held equity interest in acquiring at the acquisition date fair value. So whatever investment you are holding, equity interest you are holding, you value it at fair value on the acquisition date. What about the gain or loss? Where will you transfer? So the gain or loss will be transferred in the profit or loss account or OCI as appropriate. Why OCI as appropriate? Because that investment may be appearing as FVT OCI equity instrument. So in that case, the gain or loss will be transferred to OCI. Or that instrument may be appearing as FVTPL. In that case, the gain or loss will be transferred to profit and loss account. Okay. In your book, I have added 3 more points, which I will explain from the book. Point number A. There are 3 points A, B, C. Is it there? A. If before the acquisition of controlling stake, acquirer was holding the equity investment as a passive investor. Sir, what is passive investor? Less than 20% share. And it had accounted for the investment as FVT OCI under IFRS 9. So before this, you were just holding 10-15% share and you are not applying any of the consolidated related accounting standard. Okay. Then it will recognize any further gain or loss arising on remeasurement at acquisition date in OCI. Now, what about the earlier amount recognized in OCI? We have already accumulated some amount in OCI. So the standard says any amount related to investment previously recognized in OCI will continue to be recognized in OCI and cannot be recycled to profit and loss account. This is the same treatment that would apply if the entity disposes of its equity investment classified as at FVT OCI. Classified as at FVT OCI. And then second point, B. If the acquirer was holding the equity investment as a passive investor, say less than 20% stake, and it had accounted for investment as FVTPL under IFRS 9, then it will recognize any further gain or loss on fair value remeasurement at the acquisition date in profit or loss account. A and B are simple. Now come to C. What is C? If before the acquisition of controlling stake, the acquirer was holding the equity investment as an associate or joint venture. So now it is applying which other standard? Ind AS or IS 28. So now talk about that. Was holding the equity investment as an associate or joint venture and therefore applied the equity method to the investment. It will recognize any gain or loss arising on fair value measurement at acquisition date in P&L account. So in case if you are following equity method of accounting and then an associate becomes subsidiary, joint venture becomes subsidiary, then in that case you will transfer the gain or loss to profit and loss account. But this adjustment will be done where? In the consolidated financial statement. Is it right? In separate financial statement, we will follow the previous paragraphs. The next line is also any amount related to investment previously recognized in OCI will be reclassified to profit or loss if such reclassification was required on the disposal of the investment. Now, we have not yet studied IS 28, but in IS 28, if the associate earns OCI, we also transfer it to our OCI. And in case if we dispose the associate, we transfer from OCI to P&L account if it is appropriate. Same thing will happen here also. When you acquire or additional stake, an associate becomes subsidiary. Treat it like two events. One, disposal of associate, what you will do, and second, acquisition of a subsidiary. Is it right? So what you will do on disposal of associate or joint venture, the same treatment you will give when an associate or joint venture becomes a subsidiary. Any amount in OCI, if it is to be classified in P&L account, will be classified in P&L account. If it is not to be reclassified into P&L account, it will remain in OCI only. So that is about step acquisition. How many steps we have completed? 2. Identify the acquirer, determine the acquisition date. Step 3. Identify and measure the consideration transferred. When you acquire a business, generally you will pay the purchase consideration. Of course, there can be situations where without paying consideration also, you can acquire the control. suppose the other party goes for buyback of share, and as a result of buyback of the share of that company, our stake up increases beyond 50%. So without making any additional consideration payment, still we can acquire the control, and control can also be acquired through contract. Control can also be acquired through contract, where we do not have to pay the purchase consideration. Other than that, normally we pay the purchase consideration. Purchase consideration calculation. First principle, consideration will be measured at fair value. Consideration transferred will be measured at fair value. Of course, there are few exceptions. So we'll discuss the exception in a long list of, in a long paragraph. But normally remember, consideration transferred will be measured at fair value. The acquisition date fair value of the asset transferred by the acquirer, including cash transfer. Then acquisition date liability incurred by the acquirer to the former owners of the acquiry, and equity interest issued by the acquirer. Add following items: cash transferred, add asset transferred, add any consideration payable, deferred consideration, okay, add any equity share issued. All this will be measured at fair value. So what are the examples of consideration given in the next line? The example of consideration given can be cash, which is the very common method. Then we have any other asset, like land can be given, machinery can be given. Sometimes you may even transfer a business to other party. A business or a subsidiary of the acquirer is transferred. Contingent consideration. Oh, that we have to discuss. So contingent consideration means consideration payable subject to certain conditions, some performance target or some condition, like for example profit target, sales target. Then consideration paid in the form of ordinary or preference equity instrument, options, warrants, and the last is member interest of mutual entities. This you don't give much importance. Mutual entities are those entities which are investor owned entity that provides dividend, lower cost or other economic benefit directly to the owner, member or participants. So it's like a group of people who come together for mutual benefit, like a cooperative society. Okay, there the objective may not be to make profit, but the objective may be to benefit all the members. But don't bother about that much now. What is the principle for measurement of consideration? Fair value. But there are few areas for which the consideration will not necessarily be the fair value, but it may be as per the respective standard. Okay, as per the relevant standard. Like for example, paragraph 14, which says that exception to the fair value in determination of purchase consideration. Any portion of the acquirer's share-based payment awards. Share-based payment award, have you heard? Which standard? Hello, share-based payment, IFRS 2. So now in case if the consideration is share-based payment, any portion of the acquirer's share-based payment awards, exchange for the awards held by the acquiree's employee. Now this is again a separate long discussion we will take afterwards, that the acquiree had given share-based payment to its employee, but now the acquiree has been taken over by acquirer. So who will fulfill the promise? The acquirer will have to fulfill the promise. So this is about that kind of situation where the acquirer's share-based payment award are exchanged for awards held by the acquiree's employee, that is included in consideration transferred in business combination. If it forms part of consideration transferred in business combination, again we will discuss all these points in a while, then this share-based payment award will be measured as per IFRS 2. So this will be a separate paragraph at the end of this chapter, share-based payment award of the acquiree which has been either replaced by or will be honored by the acquirer. Then in that case, the valuation will be done as per IFRS 2. Next paragraph. The consideration transferred may include assets or liabilities of the acquirer that have a carrying amount different from fair value. Now, sometimes it may happen, you may acquire a business and you may transfer a group of assets and liabilities as a consideration paid. Okay, so it's like sometimes we call asset swapping. You acquire one business and you transfer, say, another business. Now, what you will do on the date of acquisition, recalculate the value of these assets and liabilities at fair value. And again, there will be a possibility that carrying amount may be different from fair value. So what will you do when the carrying amount is different from fair value? The difference will be transferred to profit or loss. So resulting gain or loss will be transferred to profit or loss. One example is also printed there. If the acquirer has transferred land as a part of business combination, so we have paid land as a consideration, then what should we do? First we'll find out the fair value of the land and then compare the fair value of the land with the carrying amount. Land will be derecognized from the books. The difference between carrying amount and fair value will be recognized in profit and loss account. So we'll take a problem on this type of situation afterwards. Next is another exception. Sometimes the transferred assets or liability remain within the combined entity after the business combination. Sometimes the transferred assets or liabilities remain within the combined entity after the business combination. So A acquired shares from B. A acquired shares from B and consideration paid by A in the form of land. So now where will land appear? In the books of B. Here we are assuming shares were acquired from B. So B will record land received, share issued. A will record land given, shares acquired. And suppose because of this transaction A acquires control over B. So when A acquires control over B, it means now A is going to control that land also which it has transferred to B. So therefore the standard says, since you were controlling the same asset before also and after also, you are controlling the same asset before and after also, now do not apply. What you will not apply? Fair value. You will continue to show it in the books at the carrying amount. For example, because the assets or liabilities were transferred to acquiree rather than to former owners. So when you acquire shares directly from the acquiree company and give the asset appears in the books of acquiree company. When you acquire shares from the owners, then it may not appear in the books of the acquiree company, and therefore acquirer retains control of them. In that situation, the acquirer shall measure those assets and liabilities at their carrying amount only, immediately before the acquisition date. and then shall not recognize a gain or loss in the profit or loss, as it controls both before and after the business combination. Now, one more interesting paragraph on which you will not get questions, but only for theory discussion, as it is a part of this chapter. Combination achieved without the transfer of consideration. No consideration. Still business combination. Wow. Possibility number one is that the acquiree repurchases a sufficient number of its own shares for an existing investor, from an existing investor. The acquiree repurchases a sufficient number of its own share for an existing investor to obtain the control. This example we had discussed yesterday also. Suppose there is a company in which A Limited holds 40,000 shares, others hold 60,000 shares. Total number of shares is 1 lakh. And what this company did, it bought back from outsiders. It bought back from outsiders 25,000 shares. And then now the status is there are 40,000 shares held by A, there are 35,000 shares held by others, there are 75,000 shares in the company. Before, after. Before A was holding 40% share. After this buyback, take on your calculator 40 divided by 75. Naji, all of you are lazy enough. Now somebody is taking out the calculator from the bag. 53.33%. So this is your acquiree repurchases a sufficient number of its own shares for an existing investor to acquire the control. Now, did we pay any consideration here for acquiring the control? No. But then A Limited will start applying IFRS 3. Okay. And then it will start applying consolidation also. Second example, minority veto rights lapse. What is veto rights? Have you heard veto rights? Voting right. But voting right and veto rights are not exactly same. Veto right means one person can block the resolution from being passed unless he agrees. Unless he agrees, decision cannot be taken. Possible? Yes or no? Like in Security Council in United States, okay? Security Council, UN, United Nations. There are 5 permanent members, because this word veto right is used there quite a lot. Daily in the newspaper it comes. Now 5 permanent members are there. If they have to take any decision, all 5 should agree. If one of them also disagrees, decision cannot be taken. So if India says now Pakistan should be declared a terrorist country, 4 countries says yes, China says no, it is a friendly nation, peace-loving nation. Okay, just because of 10-15 terrorists, you can't blame the whole country. Is it right? Can we blame the whole country as a terrorist nation just because there are few misguided people? No. Resolution cannot be passed. Similarly, in case of corporates also, even though a shareholder may have minority interest, less than 50% share, but sometimes they get veto rights. That means in the agreement with this shareholder, you must have given them power that unless this party agrees, we cannot take the decision. So even though you are holding more than say 50% share, but because there is a veto right with outsiders, you are not able to control the decision making. Then what do they do in shareholders agreement? They give this veto right for say 3 years. First 3 years I will give you veto right. After that your veto right would lapse and then you vote according to your shareholding percentage. The moment 3 years are over, now you will get the control. Point number 3 is contract. That is, acquiree may agree through contract that a particular entity will be the controller. So acquirer and acquiree agree to combine their business by control alone. Now in such question, when you are solving a numerical problem, assuming you do not have more than 50% share, assuming you do not have more than 50% share, whatever is the balance share will be attributable to NCI. Theoretically, it is also possible NCI is 100%. Theoretically, NCI may be 100% also, because you may not be holding any stake in the company, but you have the control because of the contract. So in that case, while calculating the NCI value, take it as 100%, no problem. Such situations are very rare. So as I said, we will not get questions on this point number ABC. So business combination contract by contract alone, last two paragraph number 15. In a business combination achieved by contract alone, the acquirer shall attribute to the owners of the acquiree the amount of acquiree's net asset recognized in accordance with this IFRS. So in fact, these remaining owners will be called NCI, and their valuation will be done even if their stake is more than 50% or even if it goes up to 100%. In other words, equity interest in the acquiree held by parties other than the acquirer will be non-controlling interest in the acquirer's post-combination financial statement, even if the result is that all of the equity interest in the acquiree are attributable to non-controlling interest. You may have studied a similar situation in Indian GAAP, that is Accounting Standard 21. Control can be acquired in two ways. Control can be acquired if you have more than 50% share in the voting power or control over board. So it is possible in some case you have only control over the board, but you don't have the share. Then while preparing consolidated financial statement, the non-controlling interest will be given entire net asset of the subsidiary. Okay. Next question, very important, tick for solving a numerical problem. When you are solving a numerical problem, these adjustments they ask you. Direct cost of acquisition. What is the meaning of direct cost of acquisition? That is cost incurred in completing this business combination process. Business combination is not a small task. Is it small task? No. It's a marriage of two entities. And just like you spend a lot of money in big fat wedding, similarly in business combination also you have to incur lot of expenses and it goes into crores of rupees. Then the question is, how do I account for these expenses? The standard is very clear, very simple. Charge to P&L account. But please distinguish between cost of acquisition and issue of securities. Issue of securities to raise funds. If there is an issue of security to raise funds, then that will not be treated as direct cost of acquisition. Then that will be accounted separately as per the respective standard, like IFRS 9. Okay. So example of direct cost, finder's fees. Who is finders? These are the specialists. You tell them we want to acquire a company, then they will do search within the country, outside the country, and then they will tell you that this is a suitable company for your business. And then there are people who perform due diligence exercise. That means ensuring that whatever is mentioned on the financial statement are actually true. Then there should not be any hidden liabilities. There should not be any hidden risk involved. Once you acquire, then you have to bear all the consequences. So therefore, a lot of due diligence is done before the company is acquired, and you write a check. Once the check is written, then the things go out of your control, and then in case of future losses, you have to bear it. That is due diligence. Then accounting costs, huge legal fees is involved, investment bankers who arrange for the deal, and then you have to pay employees, bonuses, etc. for doing a successful acquisition. All these costs will not be included in the cost of acquisition. So when we will solve few questions, this adjustment will come. You will say it will be charged to profit and loss account. But issue expenses, that is cost incurred to raise funds, will not be charged to P&L account directly. You have to apply the respective standard. For example, if the cost is incurred to raise money through equity instrument, then transaction cost is deducted in equity. Transaction cost is deducted in equity. In case of financial liability, if it is FVTPL, then it is charged to P&L account. But if it is a liability which is FVT OCI or amortized cost, then in that case, they are included in the carrying amount and adjusted through effective interest rate. Is it right? That is about issue of securities. Not relevant right now. Contingent consideration. Oh. Sir, what is contingent consideration? Contingent consideration. It depends on condition. Correct. Because when you are acquiring a company, many times there is a lot of uncertainty. A wants to acquire B. Does A know everything about B? No. Only whatever B will show, A will be able to see that. So B will show its financial statement. But you really don't know whether each and every figure is properly shown there. There may be some other liabilities which you don't know. So therefore, what many times these investment bankers do in order to crack the deal, because B would want more consideration. A says, wait, if we achieve a target 100 crore profit in the first year, then we'll pay you 20 crore rupees additional consideration. So that is called contingent consideration. This is an example. It can be any other such future event. On the happening of that future event, we will pay you additional consideration. That is called contingent consideration, because whenever with the acquisitions takes place, many times we don't know the real worth of this party. He is demanding more. We are willing to pay less. The deal is not moving forward. Okay. So how do we resolve such situation? Okay, you will also get additional amount subject to we achieve the target, because you are saying we are a very profit making company, we have so much potential, so don't worry, we'll give you, but after the condition is fulfilled. Then the accountant is asking how to do accounting of this, because this amount will be paid on happening of future event. So standard says you have to calculate the fair value of contingent consideration. Okay, fair value. That is, you have to estimate how much amount can be paid, and that is the amount that will be treated as a part of consideration transferred. Right? So, contingent consideration will also be included in total consideration paid at fair value. Subsequent accounting we will discuss subsequently. Okay. But for the time being, subsequent accounting will be done at fair value, and change in fair value will be adjusted in profit and loss account for contingent consideration. Now, how do you do the accounting of contingent consideration? You will recognize contingent consideration either as a liability or as an equity, depending upon what have you promised. If you promised cash, liability. If you promised equity instrument, then equity. But if you treat contingent consideration as equity, it will not be subsequently remeasured. But if you treat it as liability, then every reporting period you will revalue it, remeasure it, and the change will be transferred to profit and loss account, will not be adjusted in goodwill. Will not be adjusted in goodwill. On the basis of the definition of an equity instrument and a financial liability as per IS 32 or as per any other applicable IFRS. Okay. Then next is the acquirer shall classify as an asset a right to return to the previously transferred consideration if specified conditions are met. This is reverse of contingent consideration. What is reverse? If some conditions are fulfilled, the acquirer has a right to return the previously transferred condition. That is, acquiree will refund the consideration. Suppose the condition is that if there is a loss, you return 10 crore rupees back. So that will be recognized as an asset. But you will not come across many questions where this adjustment will come, where the agreement says the consideration will be refunded if certain conditions are met. But if it is there, apply the standard and show it as an asset. Now, example printed in your book, example number 4. Company A acquires Company B in April 20x1 for cash. The acquisition agreement states that additional rupees 20 million of cash will be paid to the former owner of B if B succeeds in achieving a certain performance targets. So this is a contingent consideration, because 20 million will be paid in cash only if the performance target is achieved. A determines the fair value of contingent consideration liability to be 15 million at the time of acquisition date. At a later date, the probability of meeting the said performance target becomes lower. Now, after giving this question, they will ask you, what is the amount of contingent consideration to be recognized initially? 20 or 15? 15 million. And what will you do subsequently when the fair value of contingent consideration changes? P&L account. Okay? Yes. In the above example, if the chance of meeting the performance criteria becomes less probable, then in such cases, the contingent consideration is in the nature of financial liability. Why? Because you have agreed to pay additional 20 million in cash. So payment in cash means there is a financial liability. You have to remeasure it, and the impact of the change in fair value will be recognized in statement of profit and loss. Agreed? Now you come directly to para 18. Para 18. Recognition of assets and liabilities of the acquired entity. Purchase price allocation. You have paid consideration. Now what we'll do, we will recognize the assets and liabilities taken over from the acquiree. So on the acquisition date, the acquirer shall recognize separately from goodwill the identifiable asset acquired, liabilities assumed, and the NCI. Okay. Earlier NCI was known as minority interest, but after the amendment in this IFRS 3, now they are called non-controlling interest, because this word minority is a very sensitive term. In some countries, minority means certain caste, certain class of people. So therefore, this is not a political correct word, non-controlling, neutral word. Okay. Now my task is to recognize the asset and liabilities taken over from acquiree. So the standard says, wait, you recognize those assets and those liabilities which meet the definition of asset and liability. Which meet the definition of asset and liability. Is it right? So before you check whether I need to recognize this item as asset or not, ask yourself, is it an asset? If yes, welcome. Otherwise not. So what is an asset? Asset is resource controlled by an entity arising out of past event and from which future economic benefits are expected. What is a liability? Is an obligation arising out of past event and settlement of which will result into outflow of resources, etc. Embodying economic benefits also. So now see the example. Cost the acquirer expects but is not obliged to incur in the future. Now we have to check whether this item can be recognized as a liability. Acquirer expects but is not obliged to incur in future. So as on the date of acquisition, suppose we may have a plan to exit an activity of the acquiree, or we may have a plan for termination of the employment of some employees, or we may have a plan to relocate the employees of the acquiree, but this is for future. As you know, in the definition of liability, there must be present obligation arising out of past event. These are the event that the entity would incur, may incur in future. So neither there is present obligation nor there is a past event. Wait, do not recognize these items as liability on the acquisition date. In future, whenever the liability will arise, you will account for it as per the respective IFRS. So if the termination benefit has to be given, apply your IS 19. That's good. One more interesting thing about this standard is, you may recognize those assets and liabilities which may not appear in the books of the acquiree. Possible? How is it possible? It is not there in their books. How will you recognize it? An example, brand value, okay, customer list, or similar self-generated assets, trademark, which may not appear in their books because there is a standard on intangible asset which prohibit the recognition of self-generated asset as the cost cannot be measured reliably. But for you, the acquirer, you are paying a cost for that, right? So therefore, you may recognize certain assets and liabilities which were not recorded in the financial statement of the acquiree. Example, a brand, a patent, a customer relationship also. Because nowadays this is also a valuable resource. If you have 10-15 customers, new entity does not have to take much efforts. You can already start selling to them. That the acquiree did not recognize as asset in its financial statement because it developed them internally and charged the related cost to expense. Now, recognition, there are certain exceptions to specific assets and liabilities. Normal provision is that you must recognize them at fair value in this standard. Consideration paid at fair value, we have seen some exception. Net asset acquired at fair value, but again there are some exception for certain assets and liabilities. Certain assets and liabilities may not be measured as per this standard, but will be measured as per other standards. So we'll see some of them. Like for example, share-based payment transactions will be accounted as per IFRS 2. Income tax liability as per 20 minus 8. You are right. Close. Minus 8. 12. Okay. Then contingent liability. So this standard says generally you apply fair value, but yes, some other standards may sometime override this standard. So the assets and liabilities have to be classified as per requirement of applicable IFRS, which will depend on the contractual terms, economic conditions, etc. One more thing is that sometime you may change the classification also. In their books, the classification may be FVTPL for a financial instrument. But this entity says, the acquirer says, I am not going to deal in that asset on a daily basis. I want to keep it for a longer term. So maybe you can classify it as FVT, OCI or amortized cost. Allowed. In some situation, IFRS provides for different accounting depending upon how an entity classifies or designates a particular asset or liability. See this example, just now I have explained. Classification can be changed by the acquirer. Example, a financial asset which is measured at FVTPL by acquiree or amortized cost by acquiree can be measured at FVT OCI by the acquirer. Okay. There are some more exceptions. Lease contract, insurance contract. So this will not discuss in detail today, not required. In case of lease contract also or insurance contract also, the classification depends on the condition existing on the date of inception. Whether a lease is operating lease or finance lease, that will depend on condition on the date of inception of the lease. That is when the lease starts rather than on the acquisition date. Now we'll come to another main part, measurement principle. Okay. The assets and liabilities, general principle is fair value. For everything, the general principle is fair value. Consideration paid, fair value. Previously held equity instrument, fair value. Assets and liabilities taken over, fair value. Equity instrument issued, fair value. NCI, there are two, fair value or proportionate share in net asset. Okay. So first we'll see measuring assets acquired and liabilities assumed at fair values. For non-controlling interest, there are two choices given to you. The entity will have to make a policy choice and the acquirer shall measure the acquisition date component of NCI in the acquiry that are present ownership interest and entitle their holders to a proportionate share of net asset in the event of liquidation. That means these are the outsider stake in the subsidiary. If you are holding 80% share, it means outsiders are holding 20% share. In case if the company is liquidated, they will get 20% share in the net asset. When the standard was drafted, draft standard issued, they said NCI will be measured at fair value. But then when they invited the comments from general public, like every standard they do, many commentators, those who are making comments, they said only fair value method cannot be allowed, because many times the fair value may not be available for NCI. Not every company is listed, so getting fair value may be difficult, and therefore they have suggested that we should also give one more option for recognizing NCI, and that is the present ownership instruments proportionate share in the recognized amount of acquiree's identifiable net asset. So what you will do if you are applying this method, first you calculate what is the net asset that you are taking over. Make a list of that. Okay, and then take the proportionate share. Wherever the market value per share is given, take fair value. So which one you will prefer in the exam? The first one. Of course, you can follow the second one also by writing a note. So normally the question will tell you what you have to do. If the question specifically says the fair value of NCI on the date of acquisition is 40 million, that means the intention of the paper setter is you need to take the fair value. But if fair value is not given, then you can take either of the two, write a note, because it is allowed. What will you prefer when you become the CEO of a company, fair value or proportionate share? After some years you will become CEO of some company, and then you have acquired another company, then your accountant is asking what should I do? Proportionate share. Okay. Many CEOs may preferably call it as fair value, because they want to know, in case if I have to acquire this stake fully from this NCIs, then how much amount I need to pay. Okay, that will be in MIS report. No, this is also okay, no? So that in future when you acquire the stake, you will not have to recognize too much of profit or loss. So difference will not arise much. Exception to the recognition or measurement principle. Now there is a long list. The standard will make a quick revision of many other chapters also. So exception means normally we'll apply fair value method, but in some cases we will deviate from fair value also. Okay, and sometime we will deviate from other standard also. Let us see one example, very interesting example is contingent liability. Which standard discuss contingent liability? In IS 37. What is a contingent liability? There is a definition given there in your notes. When it is a possible obligation that arises from past event and whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future event, not wholly within the control of the enterprise. Or means second definition is also applicable. It may be a present obligation that arises from past event but is not recognized because it is not probable that outflow of resources embodying economic benefit will be required to settle the obligation, or the amount of obligation cannot be measured with sufficient reliability. So what does IAS 37 says? That contingent liability should not be recognized. Contingent liability should only be disclosed. Now we are deviating from that standard. This standard says contingent liability will also be recognized in a business combination. In a business combination, contingent liability will be recognized as a recognized liability. Now you'll really credit that account in your books if there is a present obligation that arises from past event and its fair value can be measured reliably. So when will a contingent liability recognized as per this standard? Present obligation means probability of the obligation existing on the acquisition date is more than 50%. Arises from past event and fair value can be measured reliably. If these three conditions are fulfilled, welcome. It will also get recognized as a liability. So if these three conditions are fulfilled, even if it is not probable that an outflow of resources embodying economic benefit will be required to settle the obligation. So I'll just tell you 4 things for recognizing provision: present obligation, past event, reliable estimate, outflow of economic resources. If you apply IAS 37, only when all 4 conditions are satisfied, it is recognized as a liability. But this standard says if 3 are also satisfied, even if the 4th is not satisfied, then also you recognize contingent liability, right? The standard seems to be little strict on this contingent liability. Recognize it. Later on you see whatever happens, you can reverse it, you can transfer to penal account, but for the time being you recognize it. Let the liability appear in your books. Example 9. A suit for damages worth rupees 10 million was filed on company B for alleged breach of certain contract provisions. Company B had disclosed the same as a contingent liability in its financial statement, as it is considered that it is a present obligation for which it was not probable that the amount would be payable. So in their books they are showing it as a contingent liability. B is showing contingent liability. A acquires B and determines the fair value of contingent liability to be rupees 2 million. Now fair value can be determined. It is a present obligation arising out of past event. So company A would recognize rupees 2 million in its financial statement as a part of acquisition accounting. As a part of acquisition accounting means it will affect the value of goodwill calculation. Okay. Even if it is not probable that payment will be required to settle the obligation, as long as the fair value can be measured reliably. So is it not a deviation from the usual practice of accounting of contingent liability? Yes. What about income tax? For the timing, I will just say apply IAS 12, because the deferred tax asset or deferred tax liability calculation will not be done by this standard, will be done by another standard called IAS 12. The problem of deferred tax asset and liability will arise here because the carrying amount of the asset or liability and the fair value of the assets and liabilities at which they will be recognized will be different, and therefore income tax laws will not allow you the fair value. It will only allow you the carrying amount. So this will give rise to difference. These differences are of two types: taxable temporary difference and tax deductible temporary difference. Tax deductible temporary difference. If it is taxable temporary difference, it will give rise to deferred tax liability. If it is tax deductible temporary difference, it will give rise to deferred tax asset. This means you will have to pay more tax in future. This difference means you will save tax in future. But then how to do this calculation of DT and DTL is governed by other standard, a dedicated standard for accounting of income tax, IS 12. Acquirer shall account for the potential tax effect of temporary difference. Two types of temporary difference are there: taxable temporary difference, tax deductible temporary difference, and carry forwards of an acquiry that exist at the acquisition date or arise as a result of acquisition. There may be some DTA detail in their books. There may be some DTA detail which will arise at the time of accounting. Is it right? So all this will be done under IAS 12. So in this chapter we will not discuss much about deferred tax. Although in one or two questions we may be required to calculate DTA or DTL. Now what about the employee benefits? Suppose you take over another party, you have to pay the pension, gratuity to the employee of the acquiree now. Will you apply this standard or IS 19 for all post-retirement obligations? 19, because then you have to again take the help of an actuary and do all this calculation, so apply IS 19. Then there is something called indemnification asset. Have you heard indemnification asset? What do you mean by to indemnify? To indemnify means to bring back to original position. That means to compensate for the loss. To compensate for the loss. Like insurance companies indemnify your losses. Okay. Insurance company are also example, they indemnify your losses. If you suffer the loss, insurance company pays for it. Now, in case of business combination, there is a serious risk. You are acquiring another entity. You are acquiring assets and liabilities of another entity. You have also taken over their contingent liabilities. Is it right? But then you are worried, I don't know what can happen in future. With respect to some assets or some liabilities, you are not sure. There may be a debtor, but you don't know whether he'll pay or not. So what the acquiree says? What the acquiree says? I guarantee you, I assure you that if you suffer loss, now they will decide how to calculate that loss, how much loss, what is lower limit, upper limit, etc. So that will be the formula based. How do we that loss will be calculated? But at least now here the acquiree gives you an assurance that I will compensate you for the loss. Because if you have really done some big corporate due diligence, so then the question is whether these debtors are actually going to pay or not. Right? You will sell them and you will go out. But when I go and chase those debtors, are they really going to pay? Whether some extra liability will come in future, which I can't see right now. So then they indemnify the acquirer. So the seller in a business combination means acquiree may contractually indemnify the acquirer for the outcome of contingency or uncertainty related to all or part of a specific asset or liability. So it can be for an asset also like receivable. It can be for a liability also like a court case. It can be full or it can be part. For example, the seller may indemnify the acquirer against losses above a specified amount on a liability arising from a particular contingency. To keep it in simple terms, the seller would guarantee that the acquirer's liability will not exceed a specified amount. So it's like a guarantee. Will you recognize it also in your accounting? Yes. You will call it as an indemnification asset and you will recognize it. The acquirer shall recognize the indemnification at the same time it recognizes the indemnified item. So if you are recognizing the respective indemnified item, you will also recognize a indemnification asset also. And what is the basis you are going to use? The same basis as the identified item. Mostly both will be at fair value. Okay. Subject to the need for a valuation allowance for uncollectible amount. But later on, suppose you think that this party may not pay, then you can make a valuation allowance for uncollectible amount. This again a theory part. Normally questions will not be based on this portion as far as the valuation allowance is concerned. Now see one small example on indemnification asset. Company A acquires company B in a business combination. On 1st April, B is being sued by one of its customer for breach of contract. The sellers of B provide an indemnification to A for the reimbursement of any losses greater than 100 rupees. There is no collectibility issues around this indemnification. So at the acquisition date, company A determined that there is a present obligation and therefore the fair value of the contingent liability is 250. So it will recognize 250 as liability, contingent liability. And at the same time, it will calculate the value of this indemnification asset, which is anything above 100 rupees, we will bear the loss. So 250 minus 100. They will simultaneously recognize an indemnification asset of rupees 100. No, 150. Up to 100 they will not reimburse you. Exceeding 100 they will reimburse you. Now we will take a break.